Sometimes I come across companies so interesting that after digging deeper, I can't help but be impressed with them. But a lot of times, I can't find enough to talk about to make a full video. Today, I have 3 of these companies to share with you, so let's talk about them. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. Of course, these are companies to just consider. I'm not advocating that you should jump in and invest just because I said so, but with that, let's begin. Our first subject is not a traditional company. NXDT, or NexPoint Diversified Real Estate Trust, is a REIT. Formerly a closed-end fund, it held various sub-investment grade real estate. NexPoint's owner actually recently filed to convert this CEF into a REIT, which would not only change the entire way it's taxed, but also present it as more attractive to the average investor. One reason for the conversion could be that CEFs are sort of like ETFs, holding a basket of diversified holdings like individual stocks, funds, or even private equity holdings like NXDT. And there are several issues with CEFs. For example, if a CEF IPOs and has a set amount of shares, it cannot increase or decrease to meet market demand. That leads to the CEF's underlying fund becoming less tradable and subject to the large day-to-day price swings. On the flip side, a big benefit of CEFs is the traditionally above-average dividend yield, only to be counteracted by the above-average expense ratios. Thus, on the surface, it seems like there are plenty of benefits of converting NXDT from a closed-end fund to a REIT. However, given the real estate nature of the fund, it makes sense to dig deeper into NXDT. Thankfully, NexPoint lays out all of the holdings in a guide on its website. To say that this company is going to become one of the most diversified REITs on the market is a bit of an understatement. Looking at the general overview, we see NXDT operates across a number of different categories of real estate. Nearly 80% of the company is split between 3 separate real estate categories. Its largest holdings are in single-family rentals, making up nearly half of its portfolio. However, self-storage is also a very large business segment at nearly 25% of the total holdings, and coming in at number 3 is office space at just over 10%. Now seems like a good time to point out that the overview page itself claims the company holds sub-investment grade real estate. This usually refers to real estate that generally has a higher default rate, but more often than not, a higher yield in general. That may be how the CEF was able to pay out a nearly 10% dividend until it was cut. There's no doubt that the claim of diversification is accurate. In terms of growth, single-family rentals and self-storage are some of the fastest growing real estate categories. As for office spaces, I'm afraid moving forward there may be less demand for that particular kind of real estate as work from home grows in popularity. Yet with all of this, there's also something odd about NexPoint as an emerging company, something that might indicate it's severely undervalued. As of March 31st, 2022, the total net value of assets held in the fund, otherwise referred to as NAV, is $944 million. The current market cap of the REIT is only $601 million. That's a staggering 36% discount to NAV. Most real estate companies do trade at a discount to NAV, sure, but usually it's in the ballpark of 10%, not nearly 40%. Of course, there are many possible reasons for this difference, such as the uncertainty of the conversion actually going through. However, to see this extreme of a discount may be a clue that NXDT might be severely undervalued. Unfortunately, as the REIT does not yet file any formal reports with the SEC, there isn't much more in terms of valuation to get. If and when NXDT finally converts to a REIT, it'll certainly be worth a deeper dive to get a better grasp on valuation. Eventually, I expect the market cap will work its way up to NAV. The next idea is a concept a little more familiar to the average investor: spin-offs. It's no secret that they are one of my favorite investing events either. In many cases, companies frequently look to unlock value in parts of their businesses by spinning them off. And there has certainly been no shortage of spin-offs either, from Kellogg's to Intel, GE, Johnson & Johnson, and even Volkswagen. Yet one of these companies in particular has grabbed my attention. Fortune Brands and Home Security is a little-known conglomerate operating some of the most well-known and popular brands in the US: Masterlock, Therma-Tru, SentrySafe, and Diamond, just to name name a few. This company operates in almost every industry from locks to doors and virtually everything you could need to remodel your bathroom. That's why my interest peaked when FBHS announced it was spinning off its entire cabinet division. FBHS Cabinets is the company's second largest business segment, accounting for 27% of the company's total revenue. Looking at the segment is interesting itself. FBHS has managed to assemble a house of brands in a way that allows the company to have an offering in almost every consumer price bracket. You're talking about the premium custom cabinetry of Starmark and Kemper to the more price-conscious Diamond and Mantra, and even the not-to-be-underestimated KitchenCraft and Omega. FBHS has something for everyone. Of course, there are certain things to keep an eye on. However, I think the underlying business is deeply compelling. The spin-off of FBHS Cabinets won't happen for another 8 months, of course. In that time, I suspect the housing market will wane too, so we'll have to find out if there's a re-rating of this deal. What I find most interesting about the spin-off is the value proposition of the whole thing. Cabinets are FBHS's most cyclical business. With the rest of the business being very defensive, removing the cyclicality will allow Fortune Brands to have more stable earnings moving forward. A potential reason for this spin-off could be that FBHS predicts the housing market will slow down dramatically, and it would rather unload the burden of this particular business segment. Of course, this is pure speculation on my part, and A, I wouldn't blame the company for doing it, and B, it's not necessarily a bad thing. If the housing market does deteriorate faster than expected, FBHS Cabinets post-spin-off might take a significant revenue hit. Meanwhile, the core FBHS business will be able to navigate the turmoil more easily. Also, it would allow retail investors to own a world-class house of brands cabinet business at a potentially steep discount. That's why of all of the spin-offs that are in the works, I think the Fortune Brands spin-off could be one of the most compelling. Not only do you get the incredible cabinets business, but the core FBHS business will also benefit massively from this deal. Before we get into the third and final interesting investing idea, I want to quickly talk about a tiny little company I found that is fighting for a place amongst the largest brands in the world, ToughBuilt. It's not only a fairly new brand, but also a fairly new company. In 2012, the contractor-focused business burst onto the market with its fairly new and unique designs for a variety of products. We're talking 100-foot laser levels and knee pads you never knew you needed, to a tool belt so big it comes with padded suspenders. The overall brand is so clean-cut and well-presented, at first glance you'd think the company was much bigger and owned by some massive global conglomerate, but that's not the case at all. ToughBuilt, again, is a company fighting for its life. And I want to be really clear when I say this, ToughBuilt faces a near insurmountable mountain to be a company worth investing in. There are some big problems I see with the business. ToughBuilt IPO'd in December 2018. Since then, its stock has fallen 99.96%. In fact, the valuation of $13.5 million is now down to just $2.5 million. On top of this, ToughBuilt was practically forced to complete a 1-for-150 reverse stock split in order to even stay on the NASDAQ since the price fell so far. That's not even the end of it either. One of the most concerning aspects of the business is the share dilution. According to Y-Charts, the company has gone from 10,000 shares outstanding to over 1 million, split adjusted of course. Meaning if you owned 10% of the business in 2018, you now own just 0.01% today. Clearly, there's a problem. Why there's so much share dilution is because ToughBuilt is raising copious amounts of capital to fund the strategy of reckless spending of money to increase brand recognition and penetration on a global scale. So now you might hear all this and think, this is a terrible company, why are you even talking about it? And while yes, it is an awful company, I love it. There's like a 99% chance of failure, but the 1% chance it succeeds, it's like an automatic 10x your investment. And that sort of makes me excited. To me, that's what makes ToughBuilt such an interesting investing idea. There's a real brand underneath the troubling business bleeding money. A brand that's making innovative tools and kit for contractors, and a consumer base that needs efficient tools in a fast-paced industry. ToughBuilt's strategy is to spend a ton early on to get a firm foundation in order, then rein in their spending later. Many companies start this way when they're small. That's what makes the risk-reward profile so compelling. A business burning cash fast to grow a brand and hopefully getting to a point where the business is sustainable. Can they do it? Who knows? The one thing I do know is that I'll be following the story of this company in hopes of one day investing myself, but of course, not right now. On to the final potential investing idea. A while ago, I talked about a fairly infamous company boasting some of the most recognizable IPs on the planet. That's right, Activision Blizzard. Are you even surprised? If you don't already know, Activision Blizzard produces franchises like FPS-based shooter Call of Duty, team-based shooter Overwatch, and Candy Crush for some reason. Given the recent underperformance of these legendary games and some scandals, the stock sank quite a bit. That was until Microsoft offered $69 billion for the gaming conglomerate. Nice. This works out to $95 per share investors will receive the day the deal closes. While both companies have finalized everything and agreed to the deal, it's unlikely the deal will actually be completed until June of next year. Until then, Activision Blizzard will continue trading on the stock market as its own entity. Since the deal is finalized, you might think that the stock would trade at $95 per share, but that's not the case. Currently, Activision Blizzard trades at $78. To newer investors, this looks like free money. Buy tons of Activision Blizzard now, wait 8 months or so, and make a $17 return on every share. Simple as that. But the reason why Activision Blizzard trades so cheaply is pretty simple. There are several risks to every acquisition. For instance, we just saw Tesla's CEO back out of his proposed acquisition of Twitter. This collapsed Twitter's share price as it officially cements the end of the potential buyout. If Twitter was trading at the buyout price, the loss of investment could have been far greater, and investors discounted the stock based on the potential risk of the deal falling through. You also run the risk of regulator intervention, stalling or stopping any new deals. A few recent examples include the FTC intervention to stop Nvidia's proposed acquisition of ARM, and Lockheed Martin's buyout offer of Aerojet Rocketdyne. All of these events caused the stock price of the potentially acquired companies to dive significantly, and usually for the acquirer to rise. This discount is fairly universal across the market as well. Depending on the various risk levels involved in a deal, the gap in price will be different. Revisiting earlier examples, Twitter's trading price post-buyout announcement was roughly 8%. In terms of the Lockheed Martin deal, the gap was only 5%, which indicated that investors thought the deal was a sure thing. Now, going back to Activision Blizzard, we see that the gap in the trading price and the deal proposal is nearly 15%. This could indicate that investors don't have much faith in the deal working out. Indeed, the buyout has faced scrutiny, particularly from European regulators. Currently, Microsoft's deal to acquire Activision Blizzard is under review by the CMA in the UK, the same firm that helped strike down the Nvidia acquisition a few months prior. With all this hype surrounding the deal, I was certainly surprised when Berkshire Hathaway took a position in the video game giant. Buffett explained his reasoning at the most recent shareholder meeting. In short, he believes the deal has a high likelihood of going through, leading him to invest a large amount of money into the company. Overall, there are risks with the deal in general, but I also think there's a high likelihood the deal will go through as well. No, I'm not just being swayed by what Buffett says either. Once everything is finalized, and if I do take a position, it would be a nice 15% gain from basically zero effort. So, I'd love to know what you think. Are any of these companies worth it to you as an investor, or will you keep as far away from them as possible? Tell me in the comments below. But that's all I've got for you in this video. If you like this style of video, where I just talk about different companies or ideas in one go, let me know by hitting that like button. I'd love to make this an ongoing, occasional thing in the future. And of course, if you did enjoy this video, there's a high likelihood you'll like the video popping up on screen now as well. But that's it. Until next time, I'll see all of you in the next episode of Dollars and Cents.